Hello there, this is Victor here. Welcome to the Intelligent Investor channel. Nvidia is one of the best performing stocks this year. For example, at the time of making this video, Nvidia stock already increased as much as 64% year to date. In comparison, the S&P 500 only increased about 4.5% year to date. And if you bought Nvidia stock near the bottom here, Nvidia has more than doubled. Nvidia stock has increased a lot in recent months because of the extremely popular ChatGPT, the generative AI hype we hear about every day, the large language models that are used to train ChatGPT, Microsoft's AI chatbot and Google's AI chatbots, and of course Nvidia's most recent Q4 earnings that beat analysts' expectations. Nvidia CEO Jensen Huang said this in a recent earnings call. AI is at an inflection point, setting up for broader adoption reaching into every industry. From startups to major enterprises, we're seeing accelerated interest in the versatility and capabilities of generative AI. We are set up to help customers take advantage of breakthroughs in generative AI and large language models. Our new AI supercomputer with H100 and its transformer engine and quantum 2 network fabric is in full production. Gaming is recovering from the post-pandemic downturn, with gamers enthusiastically embracing the new ADA architect GPUs with AI neural rendering. Right now there's a lot of hype about Nvidia stock, so in this video I'm going to talk about these topics and explain why I believe Nvidia stock is likely overvalued now. First, I will explain why I think there will be more market corrections going forward. Then I will explain why Nvidia stock is likely overvalued now. You will learn about Nvidia's long-term prospects and expected revenue growth going forward. Nvidia stock valuation. You will learn how to calculate Nvidia stock's intrinsic value per share. And what's my overall stock rating for Nvidia. If you like this video, make sure to hit the like button, subscribe, and turn on the notification button. I will continue to make many excellent stock analysis and investing videos a week that will help you become a great investor. Also, if you like this channel and want to support it, check out my Patreon blog. I've posted the link in the video description. Once you become a Patreon member, you can follow all the stocks I'm buying every month, follow all the stocks I'm investing in for the long term, and download the latest intrinsic value calculator so you can estimate whether a stock is undervalued, fairly valued, or overvalued now. Also, you have access to my latest stock ratings for all the stocks I'm analyzing. The link is in the video description. Take a look, let's start. Before talking about Nvidia stock, I want to give you a market update first. I want to explain why I think there will be more market corrections going forward. Here's why. Right before making this video, the US BEA released the latest personal consumption expenditures or PCE inflation data. The latest data shows that the US PCE inflation was 5.4% in January, up from 5.3% in December. Core PCE inflation excluding volatile energy and food prices was 4.7% in January, up from 4.6% in December. Both PCE and core PCE inflation rates in January were much higher than what the market initially forecasted. This is a huge problem because the latest inflation data shows that US inflation is still way too high above the Fed's 2% inflation target. More importantly, the latest inflation data shows that inflation, especially core PCE inflation excluding food and energy prices, is not slowing down fast enough. High inflation seems to be much more entrenched in the labor-intensive services sector. As of now, there's still a large structural labor shortage in the services sector in the US. Wages are still increasing, but at a slower pace than before. The US unemployment rate is still near a 53-year low. Consumer spending recently increased much more than what the market initially forecasted. Social Security income has increased by 8.7% this year, and many workers' wages have increased more than the required minimum pay in the US. So all these things combined are making service sector's inflation much more entrenched and not slowing down fast enough. I think it's important to understand this inflation data because they tell us whether the Fed will increase rates more or will cut rates soon. The latest inflation data shows that the Fed's current interest rate is not high enough and not restrictive enough to bring inflation back to the 2% target. Whenever the Fed increases interest rates more, stocks are always impacted the most. This is because the cost of capital for stocks is always higher whenever the Fed increases its rates. This is why I think there will be more market corrections going forward, at least in 2023. The Fed will not cut rates in 2023. In fact, I think the Fed will likely increase its Fed funds rate to a much higher level to fight inflation. For example, according to the CME Fed Watch tool here, the market expects that the Fed will raise its peak interest rate to between 5.25% and 5.5% by year end. At the time of making this video, the PCE inflation is at 5.4%. Here's the important part. To force inflation back to the 2% target, I think the Fed will need to raise its terminal rate to between 5.5% and 6% in 2023. Then the Fed will need to keep high interest rates there for a while before starting to cut rates again. Here's another thing that indicates there may be more market corrections going forward. When it comes to investing, we always need to compare our investments to US Treasury yields. For example, we need to compare the S&P 500's earnings yield to the US Treasury yields. This is to see whether stocks are overvalued now and to see whether it makes sense to invest in stocks or if it's better to invest in US Treasuries when rates are high. For example, at the time of making this video, the S&P 500's earnings yield is at around 4.7% right now. In comparison, the almost risk-free 6-month and 12-month US Treasury yields are around 5%. The 2-year Treasury yield is at around 4.78%, and the 10-year Treasury yield is at around 3.9%. US Treasuries are considered to be the safest investments because they are backed by the full faith and credit of the US government. Also, the short-term 6-month and 12-month Treasury bills are considered to be almost risk-free. The biggest risk is inflation risk. According to Forbes Advisor, investment professionals use Treasury yields as the risk-free rate or the rate of return offered by an investment that carries no risk. If US Treasury yields continue to be this high, it makes more sense for many investors to invest in US Treasuries instead of the S&P 500. The risk-free short-term 6-month and 12-month Treasury bills already have higher yields than the S&P 500's earnings yield. Also, the Fed is expected to increase rates more this year, so I think these Treasury yields will likely increase more going forward. Higher Treasury yields make stocks more expensive and more overvalued. I want to explain why I think Nvidia stock is likely overvalued now. At the time of making this video, Nvidia's expected forward PE ratio is over 50. This is very high even for a growth company. If you look at this here, you can see Nvidia's price to free cash flow is over 150, which in my opinion is extremely high. In comparison, Tesla has a bigger market cap than Nvidia and generates more free cash flow than Nvidia. If you look at this here, you can see Tesla's price to cash flow is at around 86, which is still much lower than Nvidia's price to free cash flow. Here's another sign that shows Nvidia's stock is likely overvalued now. There is a lot of hype and excitement about ChatGPT, AI chatbots from Microsoft and Google, natural language processing NLP models that can help AIs understand human language, and generative AI that can generate human-like message, essays, writing, artwork, image, videos, and codes based on users' input. There's a lot of excitement in AI as a service, large language models that are used to train ChatGPT and other AI chatbots, and many other AI applications that can transform many industries. Nvidia is the company that benefits the most from the current generative AI trend because most hyperscale cloud providers and AI researchers use Nvidia's data center GPUs such as the H100 GPU and AI supercomputers such as the DGX systems. Nvidia's GPUs are the best for AI training, AI inference, machine learning, deep learning, data analytics, AI research, and high-performance computing workloads. The largest cloud providers such as Amazon AWS, Microsoft Azure, Google Cloud Platform, and Oracle Cloud buy thousands of high-performance data center GPUs and systems from Nvidia every year. For example, OpenAI uses thousands of Nvidia GPUs to train ChatGPT. In the GPU market, the only company that can compete with Nvidia's data center GPUs is AMD. But Nvidia still has the biggest market share in both consumer-based GPUs and data center GPUs. Nvidia CEO Jensen Huang said this in a recent earnings call. He basically explained Nvidia's long-term prospects in AI and why AI is at an inflection point that will transform many industries.
The accumulation of technology breakthroughs has brought AI to an inflection point. Generative AI's versatility and capability has triggered a sense of urgency at enterprises around the world to develop and deploy AI strategies. Yet, the AI supercomputer infrastructure, model algorithms, data processing and training techniques remain an insurmountable obstacle for most. Today, I want to share with you the next level of our business model to help put AI within reach of every enterprise customer. We are partnering with major cloud service providers to offer NVIDIA AI cloud services, offered directly by NVIDIA and through our network of go-to-market partners and hosted within the world's largest clouds. NVIDIA AI as a service offers enterprises easy access to the world's most advanced AI platform, while remaining close to the storage, networking, security, and cloud services offered by the world's most advanced clouds. Customers can engage NVIDIA AI cloud services at the AI supercomputer, acceleration library software, or pre-trained AI model layers. NVIDIA DGX is an AI supercomputer and the blueprint of AI factories being built around the world. AI supercomputers are hard and time-consuming to build. Today, we're announcing the NVIDIA DGX Cloud, the fastest and easiest way to have your own DGX AI supercomputer. Just open your browser. NVIDIA DGX Cloud is already available through Oracle Cloud Infrastructure and Microsoft Azure, Google GCP, and others on the way. At the AI platform software layer, customers can access NVIDIA AI Enterprise for training and deploying large language models or other AI workloads. And at the pre-trained generative AI model layer, we will be offering NeMo and BioNeMo, customizable AI models to enterprise customers who want to build proprietary generative AI models and services for their businesses. With our new business model, customers can engage NVIDIA's full scale of AI computing across their private to any public cloud. We will share more details about NVIDIA AI Cloud Services at our upcoming GTC, so be sure to tune in. NVIDIA AI is essentially the operating system of AI systems today. It starts from data processing to learning, training, to validations, to inference. And so this body of software is completely accelerated. It runs in every cloud, it runs on-prem, and it supports every framework, every model that we know of, and it's accelerated everywhere. By using NVIDIA AI, your entire machine learning operations is more efficient and it is more cost effective. You save money by using accelerated software. Our announcement today of putting NVIDIA's infrastructure and have it be hosted from within the world's leading cloud service providers accelerates the enterprise's ability to utilize NVIDIA AI Enterprise. It accelerates people's adoption of this machine learning pipeline, which is not for the faint of heart. It is a very extensive body of software. It is not deployed in enterprises broadly, but we believe that by hosting everything in the cloud, from the infrastructure through the operating system software, all the way through pre-trained models, we can accelerate the adoption of generative AI in enterprises. And so we're excited about this new extended part of our business model. We really believe that it will accelerate the adoption of software.
I want to show you NVIDIA's latest financials here to see how the current AI trend will likely benefit NVIDIA going forward. If you look at NVIDIA's latest financials here, you can see NVIDIA earns the most revenues and operating income from data center and gaming. NVIDIA's data center business is impacted a lot in recent quarters because the US is restricting NVIDIA from selling high-performance GPUs for AI training and research to customers in China. Also, many cloud providers have reduced their budgets on CapEx, such as spending on data center GPUs and high-performance processors. So this has impacted NVIDIA's data center business in recent quarters. In the short term, I think this trend will continue for at least throughout 2023. Going forward, in a normal market when inflation and interest rates are back to normal again, NVIDIA's data center business revenue growth will likely be much higher. This is because many hyperscale cloud providers such as Amazon, Google, Microsoft, and Oracle, and other large tech companies such as Meta will continue to invest in NVIDIA's data center GPUs and systems for AI training and AI workloads. NVIDIA's gaming business is also impacted a lot in recent quarters because there's still a large GPU inventory correction after cryptocurrencies crashed. Also, PC sales are expected to decrease further throughout 2023. Because of high inflation and high interest rates, many consumers will not want to buy NVIDIA GPUs that can cost more than $1,000 each. In my opinion, I think it will take NVIDIA's gaming business at least 2 years to recover from the current PC market downturn. But according to Nvidia's management, GPU inventory correction is largely behind the company. When it comes to investing, we have to be forward-looking instead of backward-looking. This is from Seeking Alpha. According to the consensus revenue growth here, Nvidia's revenue is expected to grow about 10% year over year in this fiscal year. Then Nvidia's revenue is expected to grow about 20% each year over the next several years. According to the consensus EPS growth here, Nvidia's EPS is expected to grow about 33% year over year in this fiscal year. Then Nvidia's EPS is expected to grow 20% to 30% each year over the next several years. Obviously, these Wall Street consensus forecasts are not going to be 100% correct, but they show that Nvidia's growth is expected to be quite high going forward after inflation and interest rates are back to normal again. This is because of the large demand for Nvidia GPUs and data center systems that are used for AI training, AI research, AI applications, AI chatbots such as ChatGPT, cloud workloads, and other generative AIs that will likely transform many industries. Let me show you how to calculate Nvidia stock's intrinsic value per share, so you will know when Nvidia stock becomes undervalued, fairly valued, or overvalued. If you want this calculator, you can download it from my Patreon blog. These are the key assumptions in this calculator. First, I define Nvidia's intrinsic value as its future free cash flows discounted to the present day. I use a discount rate of 12% here. You can use a higher discount rate here if you want to be more conservative. Nvidia's most recent trailing 12 months of revenue is $27 billion. I used a free cash flow margin of 28% here. This is based on Nvidia's average free cash flow margin in the past 5 years. There are 3 case scenarios here: worst case, normal case, and best case scenarios. Under the worst case scenario, we're assuming Nvidia's revenue will stay flat in 2023. Then we're forecasting its revenue will grow by about 20% each year over the next several years. Again, we're assuming Nvidia will have an average 28% free cash flow margin. If we forecast Nvidia's free cash flow over the next 5 years and discount the free cash flow to the present day, Nvidia's intrinsic value should be around $275 billion for the entire company, or $111 per share. I'm giving this scenario a 25% probability here. Under the normal case scenario, we're assuming Nvidia's revenue will grow by about 5% in 2023. Then we're forecasting its revenue will grow by about 22.5% each year over the next several years. Then Nvidia's intrinsic value should be around $312 billion for the entire company, or $126 per share. I'm giving this scenario a 50% probability here. Under the best case scenario, we're assuming Nvidia's revenue will grow by about 10% in 2023. Then we're forecasting its revenue will grow by about 25% each over the next several years. Then Nvidia's intrinsic value should be around $353 billion for the entire company, or $142 per share. I'm giving this scenario a 25% probability here. If we add all these numbers here, Nvidia's intrinsic value should be around $126 per share. I also use this price to book valuation method to calculate Nvidia's fair intrinsic value, which should be around $427 billion for the entire company, or $173 per share. If we take the average of both valuation models here, Nvidia's intrinsic value should be around $149 per share. In comparison, Morningstar estimated Nvidia's intrinsic value to be much higher at $200 per share. This means I believe Nvidia is substantially overvalued at the time of making this video. So what's my overall stock rating for Nvidia? If you look at this spreadsheet here, you can see these main criteria I always look at when I analyze each stock. Again, if you want this stock rating spreadsheet here, you can download it from my Patreon blog. The link is in the video description. Under the management rating, I will give Nvidia an exemplary rating because I think Nvidia's management has done an excellent job making Nvidia the leader in the GPU accelerated computing market. Under the acclamation mode rating, I will give Nvidia a Y acclamation mode because Nvidia dominates the high performance GPU market. It's very hard for new competitors to enter the GPU market to compete with Nvidia. Intel, with much more resources, tried to enter the discrete GPU market to compete with Nvidia and has failed 2 times already. AMD is the only true competitor to Nvidia in the high-end GPU market. Under the mode trend rating, I will give Nvidia a positive mode trend because of the large demand for AI applications, AI training, generative AI, large language models, autonomous driving, high-performance computing, and cloud computing. Under the profitability rating, I will give Nvidia a very profitable rating because Nvidia tends to have a high gross margin and a high operating margin in most quarters. Under the return on capital rating, I would give Nvidia a low return on invested capital rating. Under the risk and uncertainty rating, I would give Nvidia a high risk and uncertainty rating because I think Nvidia stock is substantially overvalued now. There is still a large downturn in the PC market which will affect Nvidia's gaming business for at least one more year. Also, the US is restricting Nvidia from shipping top-end GPUs and high-performance computing systems to customers in China. Overall, I am giving Nvidia a stock rating of 11. This means I like Nvidia's management, its large economic model, and its long-term prospects in AI applications, generative AI, cloud computing, and high-performance computing. This is one of my personal growth stock portfolios here. Personally, I made the mistake of selling my Nvidia shares a few months ago, so I don't own Nvidia in this portfolio here. My plan is to buy back Nvidia shares in the upcoming months when it becomes undervalued again. Now, all these are only my opinions and my analysis based on my research. They are not financial advice. There are always risks associated with investing. You will need to do your own research and do your extra due diligence first before investing in anything. Thank you for watching this video and supporting our channel. This is Victor from the Intelligent Investor channel, and I will see you in the next video.